The U.S. housing bubble, is it really different this time? Well, yes, indeed, it is different this time. It's much worse. Hey, everybody, JJ here, back with another housing update. We try to get these housing bubble, housing price, housing market videos out at least once a week. Now, lately, I've been burying a lot of the housing news within other videos about the broader economy. So, if you are here on this channel for the housing news, you may want to check out our other episodes because we do talk about housing quite frequently and tie it in with the broader economy. Today we're going to do pretty much mostly housing, but we're going to talk about the reasons why. We're going to show you charts, why prices are continuing to rise, how fast they're rising, and what lies ahead for 2020. It's going to be more rising prices, so let's get into it. Let's start right here. This is out of Redfin, redfin.com. We're going to link to all these articles for you. And we look to the bottom right here and we see the price as of December 2019. And we see another big run up in home prices, just like we told you. And in fact, this is one of the biggest run ups since about 2 years ago. Okay, so banks are lending, mortgage rates are low, wage growth is actually about the highest it's been in about 10 years. Now, a lot of the jobs that are out there, the wage growth, and a lot of the mortgage lending that's taken place is all based on debt. If you agree that the issuance of debt equals a strong economy, then yes, the economy is strong because debt is flowing like never before. People are in record levels of debt right now, U.S. consumers, and they continue to get further in debt through all different sectors of the debt market: mortgages, credit cards, student loan debt, personal loan debt, automobile loan debt. It's all at record levels and increasing very rapidly. So, yes, if debt is the economy, which it is, the economy is strong. So, one of the biggest jumps in 2 years, and just look at the steepness of the increase here in the home prices since they started. Remember, at the end of 2018, the Fed was raising rates. There was a lot of fear in the markets. Mortgage rates were ticking up closer to 4%, 4.5%. And again, the steepness of this is reminiscent of the run up after the housing bubble went bust and starting into that recovery there. All right, so a quick look at the numbers still out of Redfin right here. Median sales price up 6.9% year over year, so almost 7%. All homes for sale, a big drop of almost 15%, so inventory is dropping because of the surge in the demand. It is definitely a seller's market out there in just about every city. There's a few exceptions. Now let's look at supply of homes, also known as inventory. We see a huge drop, nearly 15% decline, and these are year over year numbers. Now, which cities are seeing the biggest price growth? Well, the answer is Memphis, Tennessee had the nation's highest price growth, rising 15.9% year over year. Camden, New Jersey, also in there at 14.7%, the second highest, fastest rising prices in the nation. Cincinnati, Ohio, 14.4%, followed by Honolulu, Hawaii, 14.1%. Newark, New Jersey, 13.4%. Only two markets saw price declines year over year in December, according to Redfin, and that was New York City and San Francisco. Both of those cities, rather, saw some of the biggest rising prices, some of the fastest rising prices in the past 5 to 10 years. Now, what is with all the demand and the low inventory? Well, it's low mortgage rates once again, combined with loose lending. We talked about that a few episodes ago. Right now, the banks don't have much risk. They're being propped up by the central bank, the Fed, and they can just keep lending. And weekly mortgage applications soared 30% as homebuyer demand hits the highest in 11 years. Think about that, the highest in 11 years. That takes us back to the financial crisis era. Everybody, this is so simple to see. Where there's debt, where banks are lending, and where there's loose lending, you're going to see more demand and rising prices. It's pretty simple. I know a lot of people down in comments have been telling me I'm crazy because I say the home prices are going to continue to rise throughout 2020 and the economy is going to stay looking strong. Now it's based on debt, so is it really strong? No, but it's going to stay looking strong because of the debt. And if you don't believe me, let's take a look at this next chart right here. This is mortgage debt. And what happened in the 2000s there leading up to the housing bubble? Well, debt increased exponentially. What happened after that? Banks pulled back. They didn't lend as much. A lot of cash buyers came in and institutional buyers came in with cash to buy homes because banks, again, were not lending as much as they were, and debt decreased. And guess what? Home prices decreased at the same time. It is not a coincidence. Again, it is not a coincidence. Debt creates demand and it causes rising prices. When the banks pull back on the lending, debt drops and home prices drop. It's so simple. But yet people are still out there acting like the debt increase and the home price increase is some sort of just coincidence. And then they see the debt decrease and home prices decrease, another coincidence. And we look here to the far right, debt increases again beyond where it was prior to the housing bubble, and home prices are increasing again. Can you believe that there's people out there that still cannot connect these very simple basics? Right? Connect the dots, right? It's so simple. So now, is it a good time to buy? Well, ask yourself, is the Fed going to continue to prop up the banks to infinity? Will they continue to allow mortgage debt to rise into infinity? If you believe that, if you believe the central bankers are going to make that happen or allow that to happen, then it's a good time to buy because you're going to buy and your home's going to be worth more next year than it is now. If you think, no, the Fed is not going to keep this up forever, at some point there's going to be a reckoning day, there's going to be a correction, this debt illusion can't last forever, then no, it's not a good time to buy. But then again, everybody's situation is different. I'm not giving financial advice. If you're a cash buyer, and if you've got 10 years of property taxes saved up and you're prepared for a job loss and you're prepared for an economic downturn, then go ahead and buy, even if you think the Fed's going to pull back, because you're in such a strong cash position that you almost can't lose. Finally, let's look at the Fed funds rate again. And I know what you're saying, JJ, not again. This chart, we've seen this chart so many times. But I still have people out there saying that it's not different this time. Well, it's different. It's much worse. But look at the steepness of these interest rate hikes in previous bull markets, and then of course followed by a recession. But look at the steepness here leading up to the housing bubble bursting, and then this time not as steep. We've never seen such steadiness in the rate increases. It's typically a very rapid, aggressive rate hike out of the central bank. We're not seeing that time. It was very slow and steady, very cautious, if you will. And then they did not continue to increase the rates. They had to start cutting rates. Before there was blood on the streets, we started seeing some pain. A lot of confidence was being sucked out of the market. The stock market started to drop. Home prices started to level off and drop big in some markets. And now we have reversed that, and it's all because of the Fed and the lending that's being propped up right now because of the Fed. It's pretty simple, and it's more of the same, and it's going to continue to be more of the same throughout 2020. Okay, unless you think the Fed bankers purposely want to crash this market. If they could, or if they wanted to, they could. All they would have to do is raise rates, let the banks fail, stop the repo liquidity injections into the market, which is billions a day, and this market would come down hard and fast. Okay, we're going to wrap it up right here. John Malden is out there with another article. Came out earlier this month. The Fed is creating a monster bubble. Well, I think we all know that. But he's got some real good analysis here. The question is, how much bigger will the Fed blow this bubble? And let's look at what else Malden is talking about here in this article. History's loosest monetary policy. We now have had 30 plus years of ever looser monetary policy accompanied by lower rates. This created a series of asset bubbles whose demises wreaked havoc wreaked economic havoc. Artificially low rates created the housing bubble, exasperated by regulatory failure and reinforced by a morally bankrupt financial system. And with the system completely aflame, we ask the arsonist to put out the fire, right? I like that. Ask the arsonist to put out the fire, and the banking system is morally bankrupt. Right, so this article is a harsh wake-up call for those doubters that this is an economic bubble. It doesn't mean that it can't get bigger. I'm not saying that. I'm not saying there's going to be a recession or a decline anytime soon. I'm saying the Fed right now has a vested interest in pumping this bubble. You say that again. The Fed has a vested interest in pumping this bubble bigger, and I'll let you figure it out. I think you know if you've been on this channel. Let me know down below. Are they going to continue to pump it up after the end of 2020, or is the incentive to create this economic illusion or the illusion of a good economy, is that incentive going to disappear after the end of 2020? I think you know the answer. Most of you, anyways, probably know the answer, but let me know. Thanks for watching. I hope all of you are well. We'll see you next time. Bye for now.